Hi, everybody. This is Paul Scheuren with Impact DataSource. Thank you again for joining our third and final webinar in our series on economic development incentives. We started out with Incentives 101 with Ellen Harpel from Smart Incentives, and we got a big picture overview of the process that is economic development incentives. And in our second webinar from last week, we went on to kind of a deep dive on impact analysis and the deal impact analysis as we think about it. Then today we're going to be talking about tracking and reporting economic development effectiveness. I'm also, let's see, again, we're recording the webinar today and we'll make the video available on our website. We'll post the slides on our website along with the videos and slides from our whole series. So you can find more information on that in the email that's coming tomorrow. If you're really impatient, you can just check out our blog because that's where I'm kind of compiling all this information. I'm also trying to keep today's webinar a little bit shorter than the others so I can leave time for a good bit of time for questions. So if you've got questions about anything we've discussed to this point or questions that pop up from today's presentation, please send those questions in the GoToWebinar panel. I've got a few questions from the sign-up process that I'm going to try and take a stab at answering as well. So with that, let's rock and roll. So we've got this just slide here about Impact DataSource. Hopefully everybody knows who we are at this point. We're economic consultants focused on economic development impact analysis. We produce and support customized impact models. So these are tools that let you do the analyses yourself, or we can take up a study for you on an as-needed basis or kind of a one-off basis. We've been doing impact studies for 20 years, so we've seen a lot of different deal types and can share some of our knowledge on that. You may be familiar again with my partner Jerry Walker, who founded Impact DataSource in 1993 and was on our first webinar with Ellen. So the first thing I want to do is just an overview for today. I'm going to start off with picking up where we left off with the impact analysis. I jammed a bunch of information into the second half of the last webinar, so I'm going to hit a couple related topics that will lead us into today's focus on tracking and reporting. With impact analysis, we want to just talk a little bit more about how to interpret the results and what you should be looking at, closely, and why it's so important to be able to run multiple scenarios. Then we'll discuss performance agreements, and you'll get my kind of non-attorney opinions on performance agreements as I see it from my position as an economist working on these impact studies. My insight shouldn't be a substitute for legal counsel for your specific case by any means, but we, Impact DataSource, we're in a unique position working with so many different communities that are evaluating some incentives or trying to make agreements or helping our clients evaluate projects once the deal has been struck. So take our insight for what it is, but hopefully it will be useful for you. And then I want to take a look at a real-world local incentive agreement and try to dissect it a little bit and see how it lines up with everything else that we're talking about in today's webinar. And then finally, I want to just talk a little bit about a type of report that we prepare for some of our clients, and we call it an economic development performance report. And so in the what have you done for me lately kind of world that economic developers live in, sometimes you need to show the impact of your hard work for the last year or maybe over the last couple of years. And so with this economic development performance report, what we do is we look at the impact of multiple projects and add it all up and then provide some metrics about those combined the combined impact of the ED organization. So kind of boiling it down to something like for every $1 invested in economic development, the city or state receives X amount in new salaries or X amount in new taxable property. So that's a good overview for what we're talking about. And everything that we're talking about today is all an attempt to avoid this kind of thing that we see here. Everyone wants their deal to end up in the newspaper, but sometimes it might end up there for the wrong reason. So today's discussion and really the entire three-part webinar series is focused on doing your best to avoid this outcome and have a positive experience essentially with economic development incentives. And so I wanted, as I mentioned, we're going to start kind of going back to that impact analysis part of it and tying it into tracking and reporting and monitoring and so on. So if we go back to our project beta from last time, we were looking at that. And I want to talk about how do we consume an impact analysis. So what are we looking at? And so what should we be looking into detail? And let's remind everybody how that was set up. So we had a manufacturer that was making, or that was, it was going to make a $15 million capital investment split out between real and a personal property there that we can see. So a big chunk of that was the FF&E, about $15 million of FF&E alone. And they were going to have some taxable inventories, and they were going to hire 74 workers earning about $100,000. So not too bad of a project there. This is still the setup in a Texas community, so the local Texas taxing structure kind of drives what we're about to look at in our impact analysis. And just taking that project beta and taking a look at it here to remind everybody of this dashboard view for the impact for the city. We had about 103 total jobs created, a small amount of residential development expected. Overall, we're looking at a net benefit down here, the net benefits of about $772,000 over the 10-year period. Okay, and so we can look at those net benefits, the $772,000. We can look at that over maybe a 10-year horizon. And so in this graph, we can also see, we can see the benefits, we can see the costs, and we see the net benefits year by year. And so we can see the net benefits there represented by that dark line through the graph. If I was describing this graph, I'd say it kind of goes up and back down. So years 2 through 10, you can see the net benefits is falling over time. If you're wondering what's going on there, I can tell you because I've looked at a bunch of these. The company, if you remember, was making a huge investment in FF&E, so that equipment. And obviously the FF&E is in Texas is going to be on the tax rolls. It's going to generate some property tax revenue, but FF&E is expected to depreciate over time in kind of the real world and in our model. And so what you see is essentially that decline over the time period is almost entirely driven by that depreciation assumption that we have in the model. And so these are some of the things I'm thinking about as I'm just kind of reviewing these results and thinking about it. What else should we look at? A good place to start would be that rate of return or payback period. So we talked about the net benefits, but now we can also think about if again this was the scenario of about $151,000 incentive, what kind of rate of return and payback period does that give us? There was no abatement, so we just have the incentive in this case. Looks like we have a pretty reasonable rate of return and a payback period, all things considered. Now, as we think about making this incentive, we might be curious to know what's driving the net benefits, so we can dig in a little bit on that. And so first of all, do the impacts in our analysis kind of result from some questionable assumptions about how many new workers are moving to the area, or maybe is it more driven by, some assumptions about the project itself? And so this table that we're looking at now can help us answer that that type of question. And so we can see here we've got the benefits and the costs broken out by source. So we've got two columns, and the total is still that $772,000. But we can see now where that net benefit breaks down between whether it's from the project or from the new workers. And we see about 94% of the net benefits are resulting from the activity tied to the project or the company itself, versus only 6% from the new workers. Also, as I'm looking at this, I kind of see we have this utility revenue. This is the city-owned utilities. We've got about $110,000 in revenue coming in. There's a cost to provide those services. We see that's about $100,000. So the difference here, $110,000 in utility revenue versus the $100,000 in utility services, means that the city's kind of making a little bit of money on those utilities, and that's the case that we see from time to time with communities where maybe there is a little bit of a margin. Sometimes the utilities are just a straight wash. Sometimes you see the utilities might be imposing a little bit of a cost. So for more water use, there actually may be some more cost to provide that than they're actually receiving the revenue. And then the other things that we could investigate is what's driving the benefits, and so what are the most significant revenue sources. And a good way to do that, so to look at this this information, would be to kind of put it up on a chart. And so here we have a chart of those sources of revenues, and this helps us a good bit in digesting that revenue data. So far and away, first of all, you can see that the FF&E property tax revenue is the largest contributor to revenue. It's $442,000. Remember, our net benefits were only $772, so a big chunk of that is coming from FF&E. Now, the second biggest one we can see there is inventory property taxes, that's about $210,000. So these tables and charts are very interesting. It can help us understand how the city will benefit from the project. From just those two items, the FF&E taxes and the inventory taxes, it works out to be about 85% of the overall net benefit. So we kind of know that those two are kind of in the driver's seat for the impact as we've calculated it here. Now, I want to just mention a couple of other benefits to using the model. As we were looking at the detail, that kind of drives some other questions. One of the biggest benefits is in using a model is the fact that you can look at a couple of different options or different scenarios, even help determine if a particular assumption that you might be uncertain about is all that important to the analysis, or maybe it doesn't matter what you pick. So, for example, if a company, from our example, it seemed a little uncertain about the projected taxable inventories. Let's say they didn't know if that was going to be taxable. Maybe it's going to be some of that would be subject to Freeport exemption, so they wouldn't be subject to those taxes. Whatever this case may be. But if we were to say that to rerun that analysis with no inventories, how does that affect the overall net benefit from the project? And so in this case, and so if you were to run that, you just want to look and say, is that still acceptable? If I'm kind of questioning those inventories, how's that affect things? And I ran it, and we were at like a 1.5-year payback period. And if we take out the inventories, we still hit 1.7. So there's still some early revenues that are kind of causing this to still have a pretty strong payback period, or to be able to cover that $150,000 incentive. And so another scenario might be where you're presenting this to your board and they don't believe in the voodoo spin-off economic impacts. And so if you were to eliminate the indirect and induced impacts from the entire analysis, and so you were just focusing on the direct impacts of the 74 workers and not being able to include the spin-off from the 20 or 30 spin-off workers, how does that affect the net benefit and the payback period and the rate of return? And so I ran that in this case for the one that we were just looking at, and we had net benefits of about 772 beforehand. And if you take out if you set the multipliers all to 1 so that there's only direct impacts there, it drops by about $10,000. So from 772,000 down to 762,000. Not a big change there. Your payback period doesn't even shift at all. Your rate of return just adjusts slightly. So in my experience, it's in particular just about this one about economic impacts. Eliminating those spin-off impacts usually isn't all that significant. It obviously depends on the project and kind of what's going on in it. But in most of the models and analysis that we put together, the spin-off impacts aren't really swinging the analysis too far. And this goes back to kind of my thesis that the economic developers should focus more on the net fiscal impacts as opposed to just hanging your hat on economic impacts, which may be hard to kind of compare to incentives. Another big benefit in using a model would be this idea of consistency. And so once you get your board or council or state legislature kind of comfortable with the approach and the analysis that will be prepared, you can get down to arguing about the merits of the project or the level of the incentives, and you're not arguing about the model necessarily. So if you have a different type of analysis that's submitted with each project, then what happens a lot of times is that you get bogged down with arguing about nuances of this analysis versus the last analysis and that kind of thing, and are we on the same playing field, that kind of thing. So what I'm suggesting is that ED organizations implement kind of a standard process or a model that will be applied on every project, and go ahead and maybe have the argument about the model and the assumptions being used in a broad case, but do this once kind of in the beginning and get it out of the way. I keep acknowledging these kind of arguments, so to speak, but what I'm really suggesting is kind of to get the buy-in from your board or council on the model kind of in advance of presenting a project. And we do this as Impact DataSource. We kind of do this regularly, and we help our clients regularly with this kind of step of the process. We put a model together. We have lots of experience kind of on a big picture sense, but we often can get a lot of good local insight or local input from maybe the finance department or revenue department, whoever it may be. Or maybe we need to do a meeting with the board to answer questions that the economic developer might not feel like they can answer. And so this is all kind of typical and pretty common in our experience, and kind of make smoother sailing as you go along. You also have in kind of connected to consistency here is that we can kind of compare apples and oranges. And so what do I mean by that? The approach we're taking that we're talking about with the model, we can kind of model any type of project. So you might have a manufacturing project with manufacturing jobs, or you might have a regional headquarters with a bunch of office jobs, or you could have, you know, a call center, and so you've got a bunch of customer service representatives or something like that taking phone calls. And so in all cases with this approach that we've been talking about, you're boiling it down into kind of consistent terms of net benefits, of payback period, and return on investment. So you're taking these apples and oranges, but you're able to compare them in these consistent and common terms. So this is really valuable, particularly as you work through multiple projects in a year. And so now to kind of shift this a little bit and tie it to effectiveness, how can you use an impact analysis that we're talking about to tie it to effectiveness, maybe on an individual project basis? And so one of our clients has taken a pretty interesting approach to this, and I'll share the idea with you. It may not be, you know, you may not be able to replicate it exactly in your situation, but I'll just kind of throw it out there. I think it's an interesting way to look at it. The client that I'm thinking of here is kind of a quasi-public entity, and it's involved with the redevelopment of a former military base. They own the land and buildings, and it's about 2,000 acres, and they lease this property back to private businesses. And so what they do, I'll get all of this out here. So what they do, they set some goals, and they could be in terms of jobs and household earnings and capital investment. So some pretty, you know, typical things. And so they set some goals of what they want to achieve over maybe the next 10 years, or maybe it's over the next 5 years. But they set some goals, and then on an individual project analysis, what they'll do is determine how the project how far that project will move them toward their goals. And they'll also determine kind of how much investment is required to do this. When I say investment here, we're talking about the incentive if they're giving putting some money into the project. So then they compare these two things, and they see if they're getting more bang for the buck, or if it doesn't generate its fair share of impact relative to the investment required. So if we're thinking about this, like if we take a weighted average, if this project gets us 5% towards our total goal set, and we're using about 3% of our investment capital, well, we're getting more bang for our buck in that sense, because if we kind of do some math there, we can see that our ratio is over 1. We're getting 5% toward our goal, but we're only using 3% of our resources. So we can see that one is, at least in that sense, is a good project, and shows that you're kind of moving in the right direction. It is a little tricky to explain on a PowerPoint, but it's an interesting way to look at things. And one of the biggest issues, as I think through this and talking about it with other communities, would be defining kind of legitimate goals on the upfront of kind of what they should be. And it also assumes you have some sort of investment capital, that you've got kind of a pot of funds to work from. And so this approach definitely can't be used by all ED organizations, but I just wanted to share this approach for whatever it may kind of stimulate in your thinking as you kind of work back in your community or state. Now I'm going to shift a little bit and talk about performance agreements, but before I get to that, I'm going to share kind of just a few survey results. And this is not my survey; it's actually from the International International City County Management Association, their Economic Development Survey, so the ICMA survey, and it was published last year. So I think it was published in November of last year, so it's about a year old, but I think it's still interesting and relevant information. And so first off, the survey asked if these local economic developers. So sorry again, the survey was given to local economic development officials, so it was not given to states, just to kind of set the context here. They asked if these local ED organizations perform cost-benefit analysis prior to offering business incentives. What you see here is, so most of the respondents said that they did perform a cost-benefit analysis. It doesn't go into exactly what was involved with that cost-benefit analysis, if it was just kind of more or less a back-of-the-envelope approach, or maybe just running some property tax numbers. But it's good to see that at least almost 3/4 are doing something in that direction. And then another question that I've pulled out of this, and I have the link here, you can go download the actual the PDF of this survey results. But another question that I pulled out is just, does your organization measure the effectiveness of business incentives? This is a little fuzzy to me in terms of what they mean by that, but here we've got at least anyway 3/4 saying that they do measure the effectiveness. I think the second question here, or this next question, might direct a little bit of what they meant by measuring the effectiveness. And so when they talk about the measures of effectiveness for business incentives, they have a number of categories here. The first one, they're a little wordy, but this it says the amount of jobs created by the new business, and so 90% roughly are measuring that. And then going down kind of in the most commonly measured would be first, of course, is the jobs, and then the increase in the tax base. So I'm thinking taxable value or taxable property there. The next one down that we see are the amount of money invested in construction materials and labor. So maybe would call that one construction spend. Some of these are kind of wordy. The cost benefit analysis just above, somewhere between 50 and 60%, maybe that's 55. Cost benefit analysis, I assume that's kind of like the fiscal impact analysis that we're talking about. And then new dollars invested in land, not quite sure what they mean there, if that's capital investment or what they mean specifically by when they say land, so that's a little curious to me. And then just kind of a count of the number of new businesses relocating or expanding, and then company revenues and sales are kind of further down on that list of something that probably it's not measured as often because no one wants to give it up. But I think that's kind of interesting to take a look at and see what everyone responds there. And now this last one that I'm going to pull out from the survey was just, does your organization require performance agreement for business incentives? And we've got an always, sometimes, and never. Always at 56%. I guess that's good that it's that. Maybe it could be higher, but I think 56% is not too bad. The sometimes category, I'm wondering, there wasn't, I didn't really see this in the survey, but I'm wondering if maybe there's just some sort of threshold in terms of the size of the incentive or the details of the business incentive that would either require or not require this, kind of get us in that sometimes zone. I can understand it if it was maybe a small, relatively small amount. You may not do an agreement, I suppose. But that's just kind of setting the tone here a little bit for what we're going to talk about next, which are these performance agreements. So I'm going to just walk through a little bit of kind of an outline of what I've seen and what I've observed in performance agreements. I don't know that I'll call it best practices, but I will say that it's kind of, if you're able to dissect a bunch of performance agreements, you can kind of boil it down to these facts. And so maybe if yours is either, maybe if you have a performance agreement or kind of a standard one, if it's lacking in one of these categories, maybe it's something you can look into and maybe try and beef up. So I'm going to go into each one of these in a little bit, so I'm not going to spend too much on this slide. But so a performance agreement, just kind of in a big picture sense, from what I see, you kind of specify what the economic development entity pledges to do, or maybe it's the city, or the state. What will the public entity do for the business? And of course, what does the company pledge, or what does the developer, what does the project pledge to do? And then it should specify how the company will prove that it has met the obligation. And then it should even detail the consequences if the company doesn't hold up its end of the bargain. This kind of outline here it's not identical to, but it touches on some of the same elements that were discussed in IEDC paper recently. There was a series of 3 IEDC papers on economic development incentives, and there was one, I think it was called Maximizing ROI, and that was that discussed performance agreements a good bit and kind of gave some outlines as well of what's a good idea to have in there. So I'm going to start off with the ED entity pledge. So this is like the state is offering this, or the city's offering this. What are they? What's being specified? And so it should give a description of the incentive. What is it? Is it a rebate? Is it an abatement? Is it a grant, or whatever it might be? And then it should be clear about how the incentive is calculated. And so if it was just X amount, then it might just state the amount. If it's going to be kind of per job created, so if it's $1,000 and there's 100 jobs, it might be described as such. Or if it's some sort of reimbursement, it might say that we'll reimburse you, and you have to provide documentation of what will be reimbursed, and so that's how the incentive would be calculated. Maybe it potentially could include a maximum amount. So again, if you have that up to 100 jobs, we'll pay $1,000 per job. Then we can kind of see that it's up to 100 jobs, and so if they create 200 jobs, well, they're only getting the incentive up to that 100. And then it should be clear on the timing of the payments. And so obviously all the companies that ever wanted an incentive probably wanted it upfront today. But and I'm not saying that that's necessarily wrong, but the agreement should specify when these payments will be made. And so whether it's if it's being paid up front, or if it's if it's on annual installments, or if it's after some period of activity is reached, it should specify that. And then on the company pledge, we want to get into the agreement should speak specifically to what you want to track or what you're trying to cause to happen. So maybe it's related to jobs or salary level or capital investment. It doesn't need to be all of these. It could be just one of them, or it could be a combination of them. Maybe it's even talking about taxable value, or maybe the agreement has some sort of minimum valuation agreement in it that would just ultimately mean that we know the tax value of this once it gets constructed, and that's sometimes useful from what I've seen. They might just be, you might even be specifying an amount of square footage. Again, timing comes into play on the company pledge. We want to say, well, when would these jobs be created, or when would this capital investment occur? And then you may kind of add other things, just criteria that are important to your community or to your state. And so I've got construction wages here. This is one in Austin. We don't work the city of Austin, but I do know, just by reading the newspaper, that the city of Austin oftentimes will require construction, if there's a development project, that the construction wages are at a certain level. You might also require maybe the use of local contractors through your in your incentive agreement. You might also encourage them in some way to hire local residents, so that these jobs that are being created are going to the local local residents. And one thing to think about here when you're defining, kind of specifying exactly what the company is pledging to do as you're putting this agreement together, I think you should go back to that prospective impact analysis and say, well, what were the main drivers of that impact analysis? And so if we go back to that example that we had with the $15 million capital investment, if you remember, the biggest drivers of that were our assumptions about the FF&E, the equipment that's coming on the tax roll is about $15 million. And then the other big one was, if we remember, it was the inventories. And so maybe the agreement that you would make for that case would be focused on those items. Maybe it's important for you to throw something in there about the jobs or the wages, but if you remember, the biggest driver of that impact analysis that we were looking at were really just those pieces of property. And it would be different in every project. And so it's important to kind of keep in mind that, while you might have a standard template or a standard agreement, a unique project might have the need for a unique performance agreement. Now we can talk a little bit about proof, and so we just want to talk about that, at least in the agreement, it should be discussed how the company will demonstrate that it's met these requirements. And so it could be, you could specify that it's going to be through employment and payroll records of different types, being very specific about what they need to show, quarterly payroll records, or just different details. Appraisal reports, if we're talking about taxable value, maybe we see something that's required where the Central Appraisal District will either you'll be pulling a report from them, or maybe you're working with the Central Appraisal District to try and confirm some of these things were done. Or it could be just other financial documents or receipts that the company has. But again, it's driven by what the company, what in the agreement, what the company is pledging to do. And so just again, be clear about what must be shown. And so if it's, you want to tie all these things together and not just leave it, in my opinion, you can just leave it open to, tell us that you did this. And so the other thing with proof, is this a one-time thing or is it ongoing? And so we'll talk about the timing of monitoring. So are you just going to have to say you created 100 jobs at the end of the first year and then you get your check and then you're done? Or do these jobs have to be maintained maybe for a period of time and the incentive is paid out after, say, a certain couple, maybe 3 years or something like that? And is there ongoing, do you need to kind of provide an annual update, or how long does that ongoing monitoring last. And so again, depending on the project, depending on the specifics of the agreement, you know, these things wouldn't just be kind of a cookie cutter thing, in my opinion. That some projects, they might have an incentive being paid out over a much longer period of time. Others, maybe it's just a smaller, small grant to help a manufacturer buy a piece of equipment or something, and there'd be less involved with maybe the proof and monitoring on that piece. And then consequences, just be clear about what happens if the company misses a target. Is this agreement kind of written as all or nothing, or is it prorated? And if it's prorated, what's it based on? So that idea of if the agreement is to create 100 jobs and you create 99, do you get anything, or is it all or nothing? If it's prorated, is it prorated? Maybe do you get 99% of the incentive? Is it prorated on the number of jobs that you actually did create, or what are these aspects? So I want to talk about a local ED incentive example next, and this is one it's kind of one that's been in the news in the last couple of years. This is the City of Plano 380 agreement with Toyota. A 380 agreement is kind of a Texas thing. Municipalities can rebate back some taxes, probably property taxes in this case, I think, I'm not sure. But they'll rebate back some taxes using this 380 agreement. It's kind of like a property tax abatement, but I think just in the administrative rules and so forth, it's maybe a little bit more flexible than doing a real abatement. So the City of Plano, I'm going to talk about this example. I actually have a link to the actual agreement text, or to the text of the agreement, but I'm going to kind of outline how this one went down. But to be clear on this one, the City of Plano is not a client, so just I don't want to make it seem like we had any inside information on the deal for the City of Plano as they put it together. We didn't do an analysis of it. We didn't prepare a local impact analysis for the project. Impact DataSource did prepare kind of the statewide analysis required by the Texas Enterprise Fund. So the Toyota headquarters moving to Plano received a local incentive agreement from the City of Plano, as well as this Texas Enterprise Fund grant. And so the Texas Enterprise Fund grant requires its own kind of application and economic impact analysis, and that's kind of shown at the state level, the statewide impact. And so Impact DataSource did prepare an analysis for that. We do a bunch of those Texas Enterprise Fund grant impact studies, but in that case we were hired by the Dallas Chamber of Commerce. So just to be clear on all of this, we didn't really have anything to do with the City of Plano deal here, but I just want to kind of throw that all out there. Also, final disclosure, I'm not a lawyer, so I'm just reading this agreement. Just take this for what it's worth, and know that I'm not really giving legal advice or even a legal interpretation of what this agreement actually says. But the City of Plano agreement kind of talks about a $6.75 million grant, ED grant, to be paid to Toyota. And it really has kind of 4 different criteria. And so if you see, the first 3 are kind of connected. So the way it was written, the city pledge, so I kind of broke this out into my terminology. So again, I'm kind of reading the incentive agreement and putting into my terminology. So we've got the city pledge, we've got the company pledge, and we've got some timing on here on the right-hand side. So this first piece for the first line is a $2.9 million ED grant, and the company's pledging to basically occupy or build 1 million gross square feet of office space and create or transfer 2,900 FTEs. And it looks like they're giving about 1,000 jobs, or excuse me, $1,000 per job there. And so they don't specify that it's up to 2.9. It's actually it's hit or miss. You either do the $2.9 million deal, or you don't get anything at all. And so if they hit that, they could also then, provided that they did kind of number 1 that's listed there, and the date that they have to do is by the end of 2017. But provided that they do number 1, they could potentially get the second and the third incentives. And so this has to do with submitting itemized relocation occupancy expenses. So this is where they're specifying exactly how the incentive will be calculated. And so it's based on itemized expenses that they can provide. And they're setting a limit. It's up to $900,000. And then they can also, another component of this was to submit permit, inspection, engineering, planning fees paid by the company. And that, again, had an upper limit of $2.2 million. and that would be reimbursed only, conditional only on that the company did what they said they would do, kind of in that line number 1 for the $2.9 million. And then there was this fourth component of adding a $750,000 incentive, or up to that amount, based on creating 750 FTE jobs by the next year, by 2018. So they are specifying that it's $1,000 per job, and so if they create 600, they would get, the 600 times the $1,000. So that's kind of how I broke it down in this case. There's some other things that didn't kind of fit on this slide, so let me go. And as I mentioned, it was kind of a mix of all or nothing and prorated. So if you remember the first piece of it, as I described it, was you needed to bring the 2,900 FTEs, and you needed to occupy the million gross square feet. That was kind of an all or nothing piece. But then by later on, it was going to be prorated based on how many jobs they actually did create. The term of the agreement was actually through, we had some marks there, as we saw in my table, of 2017 and 2018. But the term of the agreement goes through 2027 and requires some kind of annual updating or annual certification. So their proof kind of came in the form of this these certifications. And so with respect to the very first piece, the first 3 incentives, there was this Exhibit A certifying compliance with those obligations. And then there was Exhibit B, which was the annual certification, where they could prove that maybe they added the 750 jobs. And the exhibits, they're referring to these Exhibit A and Exhibit B. If you look back, you can download that PDF and look at the agreement if you want to. The exhibits are really just forms to be signed by the Toyota CFO that says we said what we we did what we said we were going to do. There really wasn't kind of at least in my reading of this, that they needed to turn over payroll records or anything other than having the CEO submit some of these documents. Maybe it's in there. I read this kind of quick. So, but it was these Exhibit B and Exhibit A were really kind of just certifying that they did what they said they were going to do. And so there was kind of a consequence. So they're continuing, those annual certifications continue to 2027. And so there was a discussion of a refund if the FTE count isn't maintained throughout that entire term of the agreement. So that was, it's interesting to kind of look at those and see how they fit into kind of some of those broad topics that I outlined in kind of a typical performance agreement. Again, as you could probably tell as I talk through that, this is all based on my advanced legal understanding of this stuff. So don't run too far with it. Feel free to check out those the actual document to kind of dig a little deeper, and probably also talk to an attorney. The other thing I'll just mention there, as I said kind of early on, Impact DataSource prepared a Texas Enterprise Fund grant impact analysis. So as a part of the application for a Texas Enterprise Fund grant, the company needs to submit an independent impact analysis, and so we did prepare that as a part of that project. So there was a local incentive that we just discussed, the 6.75 million, or up to 6.75, and then the state of Texas chipped in 40 million here, as we see, and it was evaluated by the governor, by the office of the governor here in Texas, and this was done a few years ago. Governor Perry was still the governor, and as I mentioned, the application requires this independent analysis, and it specifies in the bill, or in the application, specifically what requirements are in there. And really, we're looking for the analysis that's put forward for the enterprise fund. We're looking at the statewide impact, not anything having to do with the local impact, specifically in that analysis anyway. Now I want to get into tracking a little bit, and let's see. The question being, what should we track? And I think we can boil it down to 2 things, which are really honestly the same thing. So what's important to the project's impact, and then what's in the agreement. And so in my mind, what gets put into the agreement should be what's important to the project's impact. So you're looking at the project and identifying what are the biggest drivers. So that should probably end up in the performance agreement. And so then these 2 things will be the same. And so how should you track and monitor this information? There's 100 different ways you could do it, but I think the important part is to actually follow through on it. So I mean, it could be as simple as phone and emails, and kind of keeping that information with a spreadsheet and maybe a folder if they're going to send back some documentation or evidence to kind of prove that they did what was promised. And then maybe you can connect this into your CRM system. I know that's kind of a tricky thing, usually not set up to do that right out of the box, but perhaps you could do that. You could also contract it out, and that may not be, it may be desirable to kind of put you between, you know, the economic developer could kind of get a step out of the situation, but maybe you don't want to have that type of relationship with, you know, incentive recipients. So it's definitely a couple different options there, just kind of finding out what works best for your community and for your situation. And then the question becomes, you know, what can you do with all this data? Obviously, it's good to have a record of all this information and so on, but what can you do with it? And so I have just a couple examples here of basically these are screenshots from a type of analysis that we put together, kind of looking at a performance of a project. And so in this case, we've got, let's say that we're 3 years into a project. We want to know where do we stand, and so looking at maybe we identified these as the most critical criteria, and so we had jobs, average salary, taxable property, construction spend. And so how do they, looking at this bullet chart, how did they do compared to what was projected? So we're 3 years in, what did they do? So maybe 3 years in, they've only created 70 jobs. They had projected to create 75 jobs, so they're a little bit short of that target. The average salaries, well, they actually did better. Their average salary is higher than what was projected, and so here we can see they're actually doing a little bit better. Same thing with taxable property. They're actually on the tax rolls for a little bit more than we had projected, so they're doing better there. The construction spend, as it turned out, they actually spent a little bit less than what was projected, so they fell short of the construction spend target that was originally set. So does that mean it's a bad deal because they missed the jobs projection and the construction spend? Well, I would suggest that maybe you kind of look back through those numbers and see how it all boils down. And so that's what we did here. If we look at the net benefits for the city over the first 3 years, we can see what was projected in this column. And so the net benefits over 3 years may be about $33,000. But the actual net benefits that the city realized were actually higher, so it was actually maybe $35,000, and this is just an example. And so in this case, through year 3, the project has generated basically 6 or 7% more net benefits for the city than was projected. And so, you know, we were higher on some of those impacts, we were lower on some of them. How did it shake out? It looks like they're still at least, you know, on target or a little bit ahead. We can also look at that over the 10-year period, kind of comparing how that projection, the projected benefits compare to what the actual benefits and costs and net benefits and so on, to get a look at all of these different angles. So just on conclusion for the tracking piece, if you don't measure it, you can't improve it. So I would suggest that you try to measure it. Sometimes we hear pushback, and I almost don't know if they're kidding or not, but you know, they say maybe we don't want to know these results. And so you know, the theory or the concern being maybe we're going to track ourselves out of a job. So if we start, you know, following up on all these things and find out that these agreements didn't go as we thought, you know, we're going to lose our job. Well, I think economic development and kind of the oversight landscape is just requiring more diligence in general. And so I would kind of flip that sentiment a little bit and say maybe you're going to track yourself into job security if you show that you're doing kind of the right things and trying to keep track of what's going down. And so just kind of making a comparison here that makes it, hopefully drives it home for you. You know, it's like watching what you eat and counting your calories, but being afraid to weigh yourself. So I'm encouraging you to kind of step on the scale with this stuff. If you're doing the right things with economic development and you've got good goals and good, you know, kind of a good plan for all your incentives, it's going to be to your benefit to be tracking and monitoring all this great information. The last couple things here, I have this ED performance report that we talked about at the very beginning, and so this is where we can evaluate the impact of the operations of an ED organization over a period of time. So maybe if they worked on 10 projects in the last year, what's the impact of all 10 of those projects? So we've been talking about only the impact of one project at a time most of this webinar series, but if we added them all up, what could we calculate? So we can compare the results of those overall impacts to the funding or the incentives that were provided. So the overall funding of maybe economic development efforts in your city or in your state. And so you can get down to something where you can make a statement like, for every $1 of public investment, the ED organization supported or generated $391 in additional workers' earnings, $19 in additional local taxable sales, 40 cents in additional sales taxes for local taxing entities, $6 in additional property taxes for local taxing districts. You could even say things or be able to determine this comparison on the number of jobs created. So maybe a direct job was created with every $229 in economic development funding. Or if you consider direct, indirect, and induced jobs, a job was created with $143. So this is something that can be useful in kind of, showing the value that the economic development organization brings to the community. This is just the last slide here showing the overview of the series. If you go to our website, if you go to that fall webinar page, you can get a link back to where we've posted all the videos. We're going to send it out in an email tomorrow, but you can definitely link it up there. You can watch, if you missed either one of those earlier webinars, you can jump back and watch those. I'm going to open it up. So that's pretty much everything I had to go through here. This is just my contact information. I'll go back to that last slide. We're going to post all these slides. If you have questions, you can feel free to type those in at this point. I have some questions from earlier from the sign-up process, so I'll kind of touch on some of those right now. Let's see. There was one question kind of early in the sign-up process about, are there airtight performance agreements? And again, I'm not an attorney, but I would say that there probably are not airtight performance agreements. There's a lot of different things happening. The way to kind of improve your chance on an airtight performance agreement might be to kind of with the timing of the incentive payments, and so to not kind of put the dollars out ahead of the impacts. And so obviously that's not what everybody wants to hear, or the businesses want to hear. They have some costs probably up front, but to the extent that you can kind of tie the incentive payments to the actual performance, we can you can make things a little bit more airtight, I suppose. There was a question on, I'm looking at some of these questions in GoToMeeting or GoToWebinar here. If you have questions, feel free to type some more in. The first incentive of $2.9 million, going back to that example with the city of Plano, was that all at once, or was it spread out over time? I believe it was all at once, and I think it was a one-time payment. I can go back, or we can all go back and look at the incentive agreement, but I believe the way that was phrased, the 2.9 was going to be a one-time payment. Let's see. One other question that we have was related to kind of tax sharing for sales and TOT taxes. TOT, I guess, transient occupancy taxes. So I think we're talking about a California city in this case. So tax sharing, or I guess kind of rebating sales taxes. I believe this is probably talking about rebating sales taxes or hotel taxes. And I think it's definitely something that's common that we see in Texas with the ability to kind of have some, or we see development deals that are brought forward that way. It depends. This definitely depends kind of on a local level of what your options are legally, whether you can share some of that, whether you can rebate it, whether you have those kind of tools in your toolbox. It's definitely a good way to think about incentives where, as I kind of said before with the airtight performance agreements, where the developer or the project is kind of earning their incentive, and so that if you're rebating maybe some sales taxes or hotel taxes, the company has to basically put up before the city does, and then so if they generate some new tax revenue, sharing some of that back would be a little bit safer than just writing a check from the start. Let's see, I think the one last question, I think, Era, well, we can take a couple more if some more come in. There's one question here relating to some ED organizations kind of setting a total job goal from which they can compare an individual project's impact. And so how can an entity kind of come up with that job goal? I suppose this just kind of without having put a whole lot of thought to this, I mean, one way would be to kind of look at your current, how many jobs there are within your kind of geography currently. So if we're talking about a city, how many jobs, how many employees are there in the city? This is different than kind of your residence, you know, your where you live. So how many people actually work in your city? And maybe taking a percentage of that seems somewhat attainable. You know, and you might say that you might put this out over a 10-year period or a 5-year horizon, and maybe you find that over time you need to adjust it. But a lot of times just kind of setting out those goals, you know, after you work through it for maybe a project or two, or as you're kind of working through a year, you realize that, okay, well, that wasn't a reasonable goal. We can readjust this. I know that doesn't help when you need to go back and readjust that and explain to your board why it needs to be lower or something like that. But the fact is you can kind of go about it that way. You might also, based on your experience kind of to date, be able to think back and say, well, what would be a reasonable job projection number for us to do over the next 10 years based on what we've done over the last, you know, 5 years or something like that. So kind of the local, you know, I can't say that there's going to be a national number to use that you should try and increase your jobs by, you know, your local job count by X%. That might be, that's just impossible to think about. There's a question about how do you feel about clawbacks or refunds for full-time jobs? Well, again, we're getting the economist's opinion on a number of things here, but in this case, I think everybody, it leaves a bad taste, I think, in everybody's mouth on a clawback. And so to the extent that you can avoid that situation, I think it's probably a good idea. So how do you avoid it? I guess there's a couple different ways, is maybe to not pay it out until you're fully, you know, until the entity, so until the ED organization is fully content or satisfied that the agreed upon activity met the standards and that there would be no reason to pay, you know, to go back after the money. You know, just having an understanding about, you know, how things, I think maybe goes back to the all or nothing. Incentives are sometimes a little trickier, and maybe thinking about some way to prorate things that would be seen as fair for everybody. If they actually did have some good benefit in the community, kind of being able to kind of acknowledge that, even though maybe they didn't hit what they said they were or they agreed to, having some way to kind of prorate that back. And I think one of the ways that makes sense to me is by looking at the net benefits, again, kind of reanalyzing the project and saying, you said you were going to do this, you only did this, you know, you only generated about 70% of the net benefits. So, you know, coming to some sort of reasonable conclusion there would be, to me, the best way to handle it. So I hope this has been helpful for everybody. Again, I will say, you know, our insight is really just what it is. I mean, we work with a lot of economic development organizations, and they're all involved, or many of them are involved in looking at incentives. And so, you know, this isn't intended to be legal advice or even, you know, even necessarily best practices, but just offering our insight into what we see out there and what, you know, what other communities might be doing or thinking about. So I appreciate everybody for joining us on these webinars over the last week or so. I want to thank Ellen Harple with Smart Incentives for joining us on the first webinar, and also my partner Jerry for presenting on that first webinar as well. We're going to put these up on our website, and you'll be able to watch them there. Feel free to reach out to me or Ellen or Jerry if you have any questions going forward. And again, thank you very much for participating in our webinar.